There's two separate paths when it comes to raising interest rates, the short term and the long term. We have the three charts that explain the Fed's approach.
Plus, new home sales in the U.S. unexpectedly jumped in July to the highest level in almost 9 years. How much longer can the housing run continue?
And is climate change magnifying the dangers for housing? If sea levels rise as much as predicted by the year 2100, 36 U.S. cities could be completely lost.
We begin with our market minutes. The major indexes setting record highs earlier today, but closing near their lower levels of this session. You do have oil recovering as well, so resuming its advance. All of this in anticipation of Fed Chair Janet Yellen's speech on Friday in Jackson Hole, where she may or may not give any indication of what the Fed sees as the next rate move.
Very quiet market still ahead of that Jackson Hole meeting, as we've seen for a while. That's the big event. We did see the safety plays like utilities and staples lagging on the way up today.
Take a look at some of the stocks that were winners and losers for the day. Best Buy, for one thing, massive winner. At one point, it was up by a fifth of its value. I believe it's closing up there as well. You can see it's up $6.43 at $39.23.
That's up 20%.
Exactly, a fifth or 20%. You could say it either way. Tomato.
I like 20%.
Toll Brothers also gaining after beating on earnings. That was the case for Best Buy, and of course Monsanto gaining on reports that the Bayer M&A action could actually come through. I also want to show you Mylan. I've got that in my terminal because I have a chart of 3 days trading or 4 days trading for Mylan, which shows you 3 drops. The reason is Congress is getting serious about looking into this EpiPen pricing issue.
Oh, wow.
Mylan has drastically boosted the price of EpiPen, which is necessary for people who are allergic to nuts or bee stings or what have you. Kids are allergic to like everything these days. Now it's $600 for a pair of EpiPens. That's how much it costs for a pair, which you have to carry around in your handbag or tote or whatever.
And you need a pair at school, you need a pair in your car, you need a pair at your grandparents' house. It goes on.
So $1,200 is the least you can spend if you have one of these new allergies.
I just want to say, I've been deathly allergic to peanuts my whole life, so I was way ahead of the curve. Kids these days. Very cool.
But has peanut allergies, has the risk of death around peanuts increased dramatically over the last few decades?
It appears it has.
Okay.
But looking at government bond markets, we did see higher yields across the curve in the U.S. Of course, everyone's waiting. Very minor higher yields. I mean, the smallest tick imaginable. Very quiet action in U.S. Treasury market ahead of that Yellen speech on Friday. And one other place you want to keep your eye on continues to be Portugal. I think we mentioned this last week. Here's a 1-month chart of 10-year yields in Portugal. Look at that, 3%. That's pretty juicy, except for the fact that there are these ongoing concerns about a potential downgrade and its eligibility for the government bond buying, ECB bond buying. So keep an eye on those yields there.
All right, and in terms of currencies, the big mover today was the South African rand, the worst performing expanded major currency, approaching 14 per dollar. You can see there 13.99 from 13.58 this morning. So there's a local news report that a police unit ordered the Finance Minister Praveen Gordhan to report to its offices. This is usually given to people before they're charged with an offense and to warn them of their rights. Of course, this report raised concerns of a rift between the finance minister and the president, Jacob Zuma.
We should say it magnifies concerns
yes.
of a risk.
Exacerbates.
Yeah, exactly, because we've been worried about this for a while.
We have been worried about it for a while, and of course, Gordhan had committed the Treasury to spending caps, debt reduction, all in a bid to attract more foreign investment and convince foreign investors to put more money into South Africa.
And check out oil today. There were reports that, we keep getting these headlines. Maybe the producers are going to step in and do something about this overproduction and try and cut back production. More reports this time, perhaps something with Iran. You can see the spike there around 11 o'clock this morning, and then we ended up just over 1%.
All right, those are today's market minutes. Let's take a deep dive now into the Bloomberg. You can find all the following charts using the function at the bottom of the screen. And I'm looking at Treasuries. Who wants to get ahead of Yellen's speech on Friday? As Joe pointed out, very little move. Matt actually raised his hands.
I want to get ahead.
Very little movement before the Janet Yellen Jackson Hole speech. This is the tightest monthly trading range for the 10-year since 2006. You're looking at the difference between the highest and lowest intraday yields for the 10-year on a monthly basis. And And so far in August, right down here, it's at 16 basis points. In July, right around here, it was at 31 basis points. In June, it was at 45 basis points. So you have to go all the way back to March of 2006 for a smaller range in the yield.
By the way, it's not, I mean, you and Ramey were talking today about equities. We haven't seen more than 1% swing in equities in 32 days running.
Whoa.
So 32 consecutive days without a big swing.
In the S&P 500.
Yeah.
Wow. It's quiet. Let's take a look at the UK real quickly because, you know, it's been exactly 2 months since that Brexit vote, and we still haven't seen the economy fall out of bed, as some would expect. And in fact, there's some data isn't that bad. If we go into the Bloomberg, we have a few lines here. The blue line on this chart is the City Economic Surprise Index for the UK. That's absolutely surged. Of course, that can be a function of just the data holding steady, but estimates coming way down. But regardless, the data's coming way better than expected. Today, we got to look at manufacturing export orders also surging to the highest level in several months. And of course, why do manufacturer export orders tick up? Well, that's because of that weak pound that despite the stable data and despite things not falling apart, that remains very low. My beautiful annotations there show the story of a weak pound and the data holding up much better than expectations. So still waiting on that crash that people.
It wasn't an apocalypse then.
Not yet.
At least not yet.
There's a lag in economic data.
There will be one day.
Sure.
I
I just have a look at stocks here, and Dave Wilson pointed this out earlier. I believe, I'm going to find out who it came from because I can't remember which trading house it came from. But what it shows you is that U.S. stocks, that's the white line, the blue line, track very closely global tech stocks. That's the white line. Actually, Oliver Rennick's sitting next to me. I bet he's going to know who it was. The point is, the pink line, which is all global stocks, doesn't track either one in the last few years, because this chart goes back to 2006. So basically, U.S. stocks are tracking tech stocks much better than global stocks are tracking tech stocks. And I just thought it was very interesting. It was Dave Wilson's chart of the day.
Well, here with us now to discuss the stock market and today's action is Bloomberg stock reporter Oliver Rennick. What do you think about Matt's chart? What's that telling you?
I think it's pretty interesting. I think that anytime you see that sort of divergence, it's interesting. It's the first time I'm seeing it. But there's a lot to be said about tech companies right now. So let's just do that. Let's talk about tech stocks.
Why don't I go ahead and give credit, because I just typed up N.I. Wilson on the Bloomberg. That gives you all of Dave's chart of the day, his columns. Apparently, this chart comes from Jeff Kleintop at Charles Schwab. He's the chief global investment strategist, and he posted it in the blog earlier. So, Jeff, nice chart.
Full credit.
Yes.
Partial credit to Dave for finding it, because that's what Dave does.
Yep.
I've actually got another chart I'm going to bring up later that's also from Dave. But looking at tech stocks, a lot of interesting stuff, because tech stocks have done pretty well. Really, since we started earnings, there's been a turnaround in the shift in leadership that we've spoken about before. And then when you look at valuations, we had another story by my colleague Lu Wong the other day looking at the weighting in tech stocks compared to the rest of the S&P 500, where right now they comprise about 21% of the benchmark index.
The biggest weighting, right?
Right, the biggest weighting, which they typically are, and that number doesn't vacillate a huge amount. But right now, since the run-up in their price, since the run-up in the past month or so, they're now about 21% of the index. Financials dipping down a little bit. So there's starting to be some questions kind of emerge where people look, they say, hey, we like to see tech rally. I think most investors get excited when they see that kind of a cyclical group rally, but at the same time, they call into question about some of the earnings, some of the valuations, because you do still have a lot of highly valued stocks. But when you look at the earnings backdrop since the start of the bull market, it's very strong. I think it is sort of justify the prices that we're at.
So one of the themes I would say the theme of this market right now is how little volatility it is, how complacent it is, perhaps. One chart we have here that you've been looking at, S&P 500 implied correlations hitting their lowest level, pretty close to their lowest level since Brexit. You tend to see correlations surge during times of stress. So this is kind of another way of looking at the lack of volatility.
It is, and this is, now we've revealed Dave Wilson chart number 2. Maybe we should just have Dave on it. He's just killing it with the charts today. But he found this. This is actually a Bloomberg function that everybody should use when you have a Bloomberg. You can see in the top left there, that's the ticker SPX 3-month 3M IC implied correlation B vol index. So we have this on the Bloomberg. You can track this, and this is very interesting because if you're a fund manager, if you're anybody that is out there trying to make money in stocks, this is as important as any sort of indicator there is. Where you look at those implied correlations, we see the spike after Brexit. It's been low since, and it hasn't gone back up. The problem is whether or not investors are actually able to go in and then pick the right stocks, which becomes difficult as some of these sort of factors and sectors shift over.
It's a correlation between the different companies in the S&P 500,
correct.
not between different asset classes.
Yes, exactly.
Okay.
If you want to go back into the Bloomberg, I charted this against the VIX. And you can see how similar it is. So that when you see those surges in volatility, everything moves together. And when volatility declines, then stocks start behaving in their own separate ways.
Nice impromptu charting there.
Thank you.
That's a great observation. The trick is then, so are the stocks might be moving in their own separate ways? Are sectors moving in their own separate ways? Are the factors that you're exposed to, the sectors that you want to be in, moving separately? That becomes a little bit of a harder sort of thing to navigate. Especially when we've had a bit of a turnover. There's an article today looking at this momentum play that has come back in order, which is particularly interesting. I think Scarlett's got the chart.
Yeah, we've got the chart right here. And what's striking is that you've seen more than $400 million of inflows into the momentum ETF since the start of June. There's only been 1 week where you've seen outflows, and it's right there. It's pretty small, but everything else has been very consistent.
And that's incredible because this is, so basically right now, I think one of the big stories in the equity market is the emergence of this smart beta type strategy, which is between passive but also very active at the same time. We sort of try to capitalize not on a sector or a style, but really a factor that drives markets. And momentum is one of those factors. And back in January and February, that's why so many investors were hurting so hard, because they were trying to chase the winners, and those are the stocks that turned over and got hurt really bad right now. We know in the past 6 to 12 months which sectors have been doing very well. It's the defensive, the utilities, those types of companies, the consumer staples. So now what those flows are telling you is that if you're getting into momentum stocks right now, well, guess what the momentum stocks are? They are those value and defensive type companies, not value but the defensive type companies with the high dividends. So you have a very interesting thing that's emerging here, where people not only are seeing gains in those sectors, but piling more money into it. And that is not often you have, staples and, soap makers as your momentum stocks.
Well, speaking of the different sectors, if you come inside the Bloomberg, this is RRG, the relative rotation graph, my weather map that I like to refer to here. Within the leading sectors, Oliver, as you mentioned earlier, technology right there at the top, followed by healthcare. You don't really have any that are improving at this point. Maybe consumer discretionary moving up into that category from lagging, but a lot of those defensive plays, utilities, for instance, telecoms, are all in the weakening phase right now.
And every one of these, I like this function. It's the Jackson Pollock of market moves in some sense.
RRG go.
Right. But everything's got its own story there. So tech, I think, is part of this shift towards the cyclical companies, where you see economic data coming in surprise. We're still positive on the Bloomberg Economic Surprise Index in the U.S., which we've been over for about a month and a half. So some of these more economic-oriented companies are going to do better. But then at the same time, you also have very specific stories going on with consumer discretionary. For example, we had Kevin Kelly on the show earlier today on Bloomberg Markets talking about how that's one of the few groups where earnings have actually been doing well. And you look at the earnings trajectory there has been very solid for the discretionary companies. So as we get sort of pivoting back towards positive earnings, if that can provide a little bit of a lift to the market, I think then you're going to continue to see some of those sectors do pretty well, especially if the economic data is there.
Can I just flag another one of your colleagues? Joe pointed this out to me earlier, and if you go ahead and take my Bloomberg here, you can see Luke Kawa's most recent story. You mentioned passive investing. Apparently, someone at Bernstein put out a note saying that passive investing is worse for society than Marxism. And I like the subhead.
It's a bold statement.
At least it's an ethos.
Right. I mean, there's a lot of, this is a pretty, vocal debate right now, people on both sides of the issue. Whether or not, how long can smart beta be smart beta? Is passive investing at the root of this sort of market rally where all these stocks have moved together, where, a rising tide lifts all the boats, makes it difficult for fund managers to pick out? Now, for you and me, if we want to say, hey, I'm not a stock picker, I'm just going to get, buy the SPY or buy an ETF for a sector I like and ride it, that sounds fine. But if you're an active manager who has to justify your fees and go in and pick companies, then passive investing may not be the best thing for you if you have to compete against things moving in together in unison rather than independently.
All right, Bloomberg's Oliver Rennick. Thank you very much.
All right, we'll be right back with much more. Another headline that caught my eye on Bloomberg today: in market going nowhere, traders renew love affair with momentum. Just what we were talking about. This is Bloomberg.
Crumpton. Let's get to First Word News. A U.S. official says the FBI is investigating a cyber attack targeting reporters of the New York Times and is looking into whether Russian intelligence agencies are responsible. The news comes as federal authorities investigate a breach of the Democratic National Committee that outside cybersecurity experts have attributed to Russian intelligence agencies. A Times spokesperson wouldn't confirm the attacks or the investigation. Hillary Clinton leads Donald Trump by 16 points in Virginia. The Roanoke College poll has Clinton with 55% and Trump with 36% in a two-way race. In an expanded poll, Clinton leads 48% to 32%, with Libertarian nominee Gary Johnson getting 8% and Green Party's Jill Stein with 3%. Stein says she could win the presidential election if she could just get more public exposure. Stein says voters deserve to hear from all the candidates. The Commission on Presidential Debates says candidates must have the support of at least 15% of voters to be included in the three debates. So far, Stein has been polling in the low single digits. Tropical storm Gaston is getting stronger as it moves over the far eastern Atlantic. The storm's maximum sustained winds had increased to nearly 50 miles per hour. The U.S. National Hurricane Center says additional strengthening is forecast, and Gaston is expected to become a hurricane by tomorrow. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Matt?
Mark, thanks very much. We've seen a number of deals taking place in the private equity space just this year, over 4,600, which is a 63% increase over the same time last year. Early today, Bloomberg Go anchor Alex Steele sat down with Scott Sperling. He is the co-president of Thomas H. Lee Partners, and they talked about the LBO debt market as well as tech valuations.
What really drives valuation in our world is the credit markets. So when the credit markets are robust and debt is cheap and available, then prices have tended to go up. So it's similar to the public markets, but more of a microcosm of that. What we've seen over the last few years is that there has been in certain sectors a significant increase in the valuation multiples. So the technology sector, for example, like the public markets, has seen a very significant move, and many deals are now priced at levels, at multiples of their cash flow that are a little bit out of whack with their growth rates. So when we look at a business, we're trying to understand what are the fundamental values that make that business a sustainable grower in its industry, because it's the growth rate that really provides that strong underlying fundamental value for a multiple that you pay for that company. And in certain sectors, we're seeing that the multiples are exceeding what the math would tell you about the intrinsic value, if you will, of the company.
So here's a question for you. In the public markets, at least, technology is the only sector on the S&P 500 where analysts haven't been cutting their profit forecasts.
Right.
My question would be on the private markets. If you're invested them and the valuations are toppy, how does someone like you make an exit?
Well, there's two ways, and the way that our business has evolved, and I know specifically with our firm, but it's also true of others, is that over the course of the last 10 to 15 years, we have become much more hands-on and bring a much more intensive operating approach to our companies. So one of the things that we have to do in an environment where values are at the higher end of the historical range is to really drive significant improvements in the operating performance of our companies. And that leads to two things. One, the math of higher earnings, even at constant multiples, allows you to drive very strong rates of return in that 20% range that we in the private equity industry are looking for as a compound annual return on the money we invest. And secondly, it often leads to even higher multiples on the exit. The thing that you have to be careful about is the world is cyclical. If we ever think that somehow the world has changed and we're never going to see another down cycle in multiples, then that defies. I've been doing this for 35, almost 36 years. I've lived through 4 or 5 recessionary periods and even more cycles, and it's going to happen again.
What about LBOs? So in the beginning of the year, the market was really frozen. It's been really hard to offload some of the debt from the big LBOs of the past. Where is that debt market now?
So the debt markets are once again robust, and
Can you sell
again
for
we've seen
par
this.
or you sell for below?
In terms of the debt, it all depends on the specific situation. But what I would say is that the risk premium for the single Bs, for example, had really shot up, as you point out, earlier in the year, and now that's come back down, and so the spreads have narrowed significantly. And let's not forget that the base rate upon which that spread is added is at all-time lows. So the cost of debt is significantly lower than it was, for example, in 2007, which is the last time that we saw some of the same kind of value multiples and debt multiples on these companies.
So going forward, though, do you see the...
That was Scott Sperling, co-president of Thomas H. Lee Partners with Bloomberg's Alex Steele.
Coming up, Hillary Clinton lays out a proposal for small business owners and warns them of a Trump economy. This is Bloomberg.
What'd you miss? Well, you may have missed what the natural rate of interest is. Something we've been talking about for a long, we've been talking about it for decades, and we're going to talk about it more right now. A lot of people have said it should be 2%, or at least that's what my Taylor rule. If I type in TAYL on the Bloomberg, TAYL go, I get the Taylor rule, and the sort of default neutral real rate is 2%. That's what we heard earlier from Lou, and that's what we've sort of assumed growing up as kids, that that's what our start is. But what we're hearing now from certain members of the Fed is that it may be different and coming down. Scarlet, you pointed out a story this morning that I thought was one of the greatest, sort of most elegant walkthroughs of the neutral rate that I've read.
Absolutely, because you have a lot of questions, philosophical questions about whether the Fed needs to rethink how it approaches monetary policy, and saying that perhaps the natural rate of interest, the neutral rate, is a lot lower than what we had anticipated. But nevertheless, that doesn't change the fact that the Fed is still looking at these different data points and determining when to raise interest rates next. So if we're saying that the neutral rate of interest should be a lot lower than what it has been historically, but we're still looking at an interest rate increase. It can be kind of hard to get your head around, but what it points to is the fact that the Fed needs to look at both long-term and short-term issues and balance that out.
Right. One area that the Fed, by almost all accounts, feels that it is in balance on or has hitting its target is unemployment rate. And if you look at the unemployment rate versus what the Fed has said is the sort of full employment rate, that is one area. You can see it right there.
This is the neutral rate. And here, what I think is interesting is the long run neutral rate, the median rate in a survey is right now down around 4.8, right? The U.S. unemployment rate is right there. Sorry, I'm wrong. You're right.
This is what the Fed thinks is the central natural rate of unemployment, whereas there's huge gaps between what the market thinks might be the neutral rate of interest. On the unemployment front, it looks like we're pretty close.
And of course, that's one of the Fed's mandates. The Fed's other mandate is inflation. And if you look at core PCE, which is the metric that the Fed prefers to use, it's at 1.6% in July. Sure, it's not at the 2% target, but Stanley Fischer, the Fed vice chair, told us that it's within hailing distance. It's been slow progress, but it is moving in the right direction. If you look at that orange line, it is trending higher.
I love that line, hailing distance, because I think that's just the right way of getting closer, but still some way to go.
Stanley Fischer for coming up with new terminology.
Exactly.
Hailing distance.
Flirting with natural. I don't know. The headline flirting with natural made me think of the neutral rate.
All right. In any case, we're going to discuss Hillary Clinton's new economic proposals for small businesses. This is Bloomberg.
Let's get to First Word News this afternoon. President Obama is in Louisiana, where he got a first-hand view of the damage caused by flooding that killed 13 people and forced thousands from their homes. The president toured one of the many neighborhoods in southern Louisiana devastated by the flooding caused by more than 20 inches of rain over a 3-day period.
But this is not just about property damage. This is about people's roots. Sometimes when these kinds of things happen, it can seem a little bit too much to bear, but what I want the people of Louisiana to know is that you're not alone on this. Even after the TV cameras leave, the whole country is going to continue to support you and help you until we get folks back in their homes and lives are rebuilt.
The federal government has approved more than $120 million in assistance for residents affected by the flooding in Louisiana. An American soldier has been killed, another wounded when their patrol was struck by a roadside bomb during an operation in Afghanistan's southern Helmand province. 6 Afghan soldiers were wounded. The attack came a day after 100 U.S. troops were sent to the area to help defend the city against the Taliban. Democratic Vice Presidential nominee Tim Kaine is accusing Donald Trump of using his campaign to make money for himself. In Denver today, Kaine pointed to reports that Trump raised the monthly rent his campaign pays to his Trump Tower headquarters. Trump's camp disputes the claim, saying it needs more space in anticipation of increasing staff. The Obama administration says it's received a formal extradition request from Turkey for exiled cleric Fethullah Gulen. Turkish President Recep Erdogan has blamed the coup attempt in July on Gulen, who lives in Pennsylvania. Gulen has denied any connection to the coup plot. However, the State Department says the extradition request is unrelated to the failed coup. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Mark Crumpton. This is Bloomberg. Joe?
What'd you miss? As Mark just mentioned, President Obama visited flood-ravaged Louisiana today, confident that the state will rebuild. According to a recent report from Zillow, over the next 100 years, rising sea levels could affect more than 80,000 homes in Louisiana, 6% of the housing stock, for a total of $13.2 billion of potential underwater properties. And nationwide, almost 1.9 million homes worth a combined $882 billion are at risk of being underwater by 2100. Joining us now from Seattle is Svenja Goodell, chief economist at Zillow. Svenja, absolutely eye-popping numbers. Is anyone prepared for the kind of economic and geographical damage that rising sea levels could have on the housing market?
Well, no, I don't think so. I don't think we're at that point yet, especially given that the horizon is 100 years into the future, and people's horizons don't tend to be that long.
When you did this research, you were projecting out 90 years, 80, 90 years. But what have you found about the pace of the rising sea level over the last 5 to 10 years? Because it's obviously been a lot faster than anything we had seen in the previous 20 to 40 years.
Well, you know, I think if you look at what scientists have released in terms of how fast sea levels are slated to rise, 6 feet seems like a fairly good estimate for the next 100 years. If you're looking at, 10 years or even 20 years into the future, obviously sea levels will perhaps only rise by a foot, if even, maybe 2 feet in some areas that are lower to the actual sea level. However, it's such a short time horizon there that the real impact will come further out into the future. And I just don't think that, given that it's such a long horizon, that people are yet quite prepared for how much damage water will cause to a lot of communities right by the oceans, and how much money is going to actually be lost in all of this, especially given that our estimates are fairly conservative. We're looking at the current housing stock and the current dollar value. And if you think about the population growing, and if you think about construction into the future, we will build more homes, and more expensive homes, especially along the coasts, and more people will be affected by this 100 years into the future.
I mean, 100 years, as you mentioned, is a very long time horizon. And isn't it safe to assume that Mother Nature is going to give us a few hints, a la Hurricane Sandy, which was very expensive and kind of reminded people that Lower Manhattan is vulnerable to rising water?
Absolutely. Well, I think arguably the flooding in Louisiana that's happening right now is just a little of a reminder that global warming is happening. I think scientists have said that while this is not directly attributable to global warming, it's certainly possible that it's one of the side effects as temperatures across the globe are rising. And in the future, we can expect more of these events to happen, where you have more hurricanes, more flooding, more torrential rain, and this is just another example of how much havoc rising water levels can really cause in a community, and how many homes will be affected, and how many lives will really be affected by something like this.
We have a chart showing the top 5 cities with properties that are most at risk. I mean, I think Louisiana clearly floods easily. We know that, right? But
Yes.
for example, New York, Boston, Miami, Fort Lauderdale, Huntington Beach are all on here, and these are populous areas with incredibly expensive properties because you don't typically see floods affecting, apartment buildings in New York City.
Right, and I think Louisiana is certainly a top state that will be affected, but I think other states are even more so affected. If you think about New Jersey, as you mentioned, close to New York, Florida certainly, Hawaii will be very affected. I mean, in fact, in Florida, 1 out of 8 cities will have to deal with flooding here, and overall, 300 cities across the U.S. will lose more than half of their housing stock to rising sea levels in the future. So these are very populous areas that will be affected, and therefore we're also going to see at least $1 trillion worth of damage here.
What kind of ramifications do you think this will eventually have on home insurance, on flood insurance? I mean, we've seen how in the past 5 to 10 years, flood insurance has become something much more critical than it had been previously.
Right. Well, as you said, I think we're starting to pay more attention to this. Guidelines are becoming a bit more stricter. It's a very contested topic to look at. Are we truly insuring enough with flood insurance? Is it something that's actually not being quite as helpful as it should be? Are we underinsuring? Is that the cost of flood insurance actually capturing the whole cost of the system itself, where people should be paying more in flood areas? Does it make sense to rebuild in places where we just seen devastating floods? So I think all of these things need to be addressed in the future.
All right, Svenja Goodell of Zillow, thank you very much.
Coming up next, we discuss the state of U.S. housing. Toll Brothers CEO Doug Yearley says it is recovering, but it's not what it was a decade ago.
We're not in a boom right now. We're in a strong, solid, improving real estate market. Mortgage money is not easy. The builders are not building too much spec inventory. We don't have buyers coming in who are investors. So right now, this is a steady, solid market, but it doesn't compare to the market of the mid-2000s.
I'm Scarlet Food. It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. Volkswagen has agreed to pay a key supplier to end a 6-day standoff that halted Golf and Passat production. That is according to people familiar with the matter. They say the amount is well below Prevent Group's initial demand for $66 million. The supplier sought the money to cover factory alterations made in preparation for a $565 million order that VW canceled. AT&T has reached a deal for enhancing roaming and other cell phone services for wireless customers visiting Cuba. Terms were not released. Sprint announced a roaming agreement with Atexa last fall to allow subscribers visiting Cuba to send and receive calls as well as text messages. And more problems for Louisiana, which is already suffering from record flooding and the collapse of the oil market. The state may sell as much as $500 million in revenue anticipation notes. That would be its first cash flow borrowing in 3 decades. The state no longer has the reserves officials once tapped to pay bills while awaiting tax payments. And that is the Bloomberg Business Flash.
What'd you miss? Sales of new U.S. homes unexpectedly jumped in July to the highest level in almost 9 years. Purchases in the South were the strongest since before the start of the last recession. Joining us now to discuss the state of housing is Bill McBride, the founder of the Calculated Risk Economics blog, who correctly predicted the housing bubble back in 2005. Thanks for joining us, Bill. What do you think about this growth that we've seen, regrowth in housing? As you may have heard, we were talking to Doug Yearley from Toll Brothers earlier, who, contrary to other luxury home builders, has done quite well. He said that it's not a boom that we're in, but we're just in a sort of a strong recovery mode here.
Well, I would say we're definitely in a solid recovery. New home sales have been increasing steadily for 5 or 6 years now. We're still at 650,000, which is just one data point. It's the first one over 600,000. That's still below what the 800,000 that we kind of expect. So there's further growth ahead.
Yeah, one of the arguments, and we've been talking about it for a while on the show, that people make is that one reason to be optimistic about the economy is that the housing cycle has a long way to run just to make up for lost time during all that period when we were hardly building anything. Is that still your view, that we're still significantly underhoused?
Yeah, well, we definitely have a ways to go. I think we're going to get to at least 800,000 this cycle, maybe more. So another 20 or 30% from here. And that's a good sign for the economy going forward.
How quickly do we get to that 800,000? If the Federal Reserve is actually considering raising interest rates by the end of this year, does that make a difference in the trajectory?
I don't think they're going to raise rates too quickly, so it probably doesn't make a big difference. The growth has been slow but steady. And a lot of that, to get to 800,000, we don't need Toll Brothers as much as we need the builders who are going to build the lower-end homes, which we didn't have in the early part of this cycle. Because there were so many foreclosures, there was no reason to build lower-end homes. You only had so much developed land, you just build the high end.
But now we see, Doug was telling us, again, from Toll Brothers, that here in Manhattan, for example, the uber luxury housing market is feeling some pain. They've kind of overbuilt. We know that there's some kind of McMansion regret going on nationwide. That sector doesn't need any more stock. But the builders are finally starting to get the land and the labor necessary to build lower income, not lower income, but the lower tier housing.
Yes, and Horton has really pushed towards that. That's the largest home builder, and they're getting most of their growth at that lower end of what we call new homes.
And they're one of the most highly valued home builders, I think, trading at like 15 times earnings right now.
So on that lower end, what's more at risk of changing next, demand or supply?
Well, I think the demand's definitely there, so it's got to be supply. For us to get to 800,000 this cycle, we're going to have to see significantly more supply at that lower end, because that's where most of it's going to come from.
One of the big discussions that's going on in housing right now is there's still so much interest in the top-tier cities. You're in California, so you're around a lot of these housing markets. They've just seen incredible booms, whether it's the Bay Area or Los Angeles, or obviously here around New York. Are there signs that it's spreading, that that due to supply constraints, we're starting to see growth outside of those markets?
Yeah, and that's the historical way it's worked, is the coastal areas have recovered first when we've had downturns, and then it spreads inland. And
so where are you looking right now? What markets strike you as interesting that we should be keeping an eye on?
I would look at, well, and one of the things I do look at is the previous distressed markets. And so, maybe Inland Empire in California. Phoenix has really done well already. Nevada's but Nevada's got a long ways to go because they still have a lot of foreclosures there.
We have a regional breakdown on the Bloomberg terminal here. You can see that there's been real growth in the South and in the West as well. The Midwest is not doing quite as well as those two regions, and the Northeast is not seeing nearly as much growth. In fact, it's below the zero level.
Right. Well, I think that some of that's just pure demographics and where people are moving.
This is normalized, I should point out, from 2010.
Yeah, so I wouldn't expect much pickup in the Northeast. A lot of it's already built out. There's not as much land available. The South has the majority of the land, and some in the West too. So Atlanta, I think, has more lots than half the country together. Just sitting there, and so there's a lot of growth potential down there.
Of course, if you get the further west you get, the less affordable it is, right? I mean, I want to live in Hawaii. I wouldn't mind living in San Francisco. I'd like San Diego. I wouldn't mind living in Portland. I mean, these are expensive places to live.
They are, but an area like San Diego, if you were the inland, some of the inland areas aren't that ridiculously expensive. They are compared to the Midwest, but not to here. So, if you don't mind living 15, 20 miles from the coast, you're fine.
Sold.
I want to get back to what Doug Yearley had said, that we're not in a boom, that we're just in a strong recovery. What do you think people get wrong the most when they look at this housing recovery or this housing cycle?
What do they get wrong? Well, I think the first thing they got wrong was that they thought it was going to recover too quickly. So I think that this is kind of what we had expected, was a slow, steady recovery. I'm not sure what else people are getting wrong.
They may have expected more foreign buyers, which I wonder if with such a weak pound, we're going to see that.
Well, but there are areas of the country that have had tremendous foreign buyers. California, certain segments of California, Chinese buyers are really very important.
You look more than just at the housing market. When you look at the broad range of economic indicators, which you track several times a day on calculated risk, is there anything that's flashing yellow in your mind in terms of the overall economy?
Well, manufacturing, of course, and the oil sector has really been a drag. So,
anything that you think could tip us into a recession in the next year or two?
No, I don't think so. I mean, there's such good explanations of why certain segments have struggled, whether it's a stronger dollar or whether it's lower oil prices. Does anybody expect oil to drop another $50? Well, that'd be pretty hard. But
another central banks, you never know.
Well, another 50% is not impossible, but I think it's very unlikely at this point.
All right, Bill McBride of Calculated Risk, thank you very much for coming in.
Thank you for having me, Joe.
Coming up, Hillary Clinton vows to make starting a small business, quote, as easy as setting up a lemonade stand in the front yard. What's not clear, though, is how much her proposals would cost or how she would pay for them. This is Bloomberg.
what'd you miss? A Democratic presidential nomination, Hillary Clinton, laid out proposals to streamline financing and taxes for small businesses. Among her proposals is a new standard tax deduction that would eliminate many forms and the need to tally up overhead costs like rent and phone bills. Joining us for more from Washington is Bloomberg's Margaret Talib. Margaret, thanks for joining us. So, the questions obviously are, how is she going to achieve this, making small business tax claims easier than setting up a lemonade stand, and how is she going to pay for that?
It all sounds so simple, doesn't it? So a lot of those questions still to be determined at this stage. We know that she is talking about a standard deduction that is something akin to what's been available to individuals before. Hillary Clinton now trying to set herself up as this is not just policy, this is political rhetoric as well, as someone who is understanding of small business. And part of her timing on this is to try to contrast herself with Donald Trump and give her a predicate to raise, once again, these issues such as, has he sort of stiffed contractors or subcontractors who were small business people in the past, refusing to pay them the full amounts, that sort of thing. This gives her an avenue to talk about that, as well as obviously all of the details which would have to be worked out. There would need to be bipartisan support. You need to understand, who this would affect, how much it would save them, and where the money would come from. That's all still TBD very much.
And of course, the Clinton campaign would love to focus on that rather than having to deal with questions about the Clinton Foundation. There's an Associated Press story, Joe, about how a lot of the donors to the Clinton Foundation met with her at the State Department.
In fact, more than half of the people who met with Hillary Clinton that weren't involved with government while she was at state were donors to the Clinton Foundation. At least that's what the story claims. How much of a problem is this? How much of an ethics issue is this going to be for Hillary Clinton?
I mean, wow, we know already that the Trump campaign has long planned on continuing to hammer away at this issue of donations, credibility, transparency, any connection or perception of connection between the two. This really gives them more ammunition to do it. I mean, I think it's possible that you would hear some of the advocates for both former Secretary of State Clinton and the Clinton Foundation say that it proves the opposite, that it proves, how widely and how globally the Clinton Foundation, was sort of something that people all over the world wanted to give to. They may argue that, but this feeds, for the general public, this ongoing problem of hers in polling that has existed since the primary election, which is there enough transparency? Do people really know what she was doing as Secretary of State and how it connected kind of to the family business and this notion of favors? It's a very difficult thing to disprove, particularly when there are these continuing dribs and drabs and disclosures of emails, and most recently, the discovery of another 15,000 emails that weren't previously turned over, and we're going to see many of these between now and Election Day.
Margaret, looking at this from a meta perspective, it seems like this is a good moment for Donald Trump, if only because he's not the focus right now. We're not talking about some gaffe of his or some advisor or some link to someone outside the mainstream. We're back to talking about the problems that Hillary Clinton has to deal with. Trump campaign has to like this.
Sure. The Trump campaign does like it, unless there's something in those 15,000 emails that brings Donald Trump into it, which would be fun if that were true. Yeah, no, certainly they do, because, again, this is a focus on her and a focus on questions about that would certainly continue into office were she to be elected, which is what is the future of the Clinton Foundation and what is already kind of baked in the cake in terms of donors that over the years there are records gave to the Clinton Foundation, and would she feel any pressure?
An obligation if they'd already paid for access. I mean, the point is they're buying access to the State Department, right? 85 donors who gave more than $150 million to the Clinton Foundation got a private audience with the Secretary of State.
Now, there are two sort of separate issues. One is the idea of access. The other is the idea of favors. Thus far, these emails pretty clearly reflect the access and the linkage between if you were a friend of the Clinton Foundation and you really wanted to get that meeting, you might very well get that meeting. Whether that translated into something more substantive is absolutely going to be under the microscope in the weeks to come.
All right, Bloomberg's Margaret Talib in Washington. Thank you very much.
Coming up, what you need to know to gear up for tomorrow's trading day. This is Bloomberg.
U.S., German imports, exports, and GDP tomorrow at 2 a.m.
And more housing data out tomorrow. We'll get existing home sales at 10 a.m.
And of course, HPQ, this is the printer hardware side of the business, will be reporting earnings as well after the close. That does it for What You Missed. Thanks for watching.
We'll see you back here tomorrow.
Have a great evening. This is Bloomberg.